I am delighted today to serve as the lead panelist for these two very distinguished speakers. And as you know, we're here to talk about the implications of the recent bank failures. But what we really want to talk about is those implications on really all board risk oversight and how those might affect you as directors in your role on the various boards that you sit on. And we're going to take a few minutes and let Mark kick us off and let him provide his perspectives on these recent bank failures. And then Chris will pick it up and provide his perspectives from his role in the insurance industry. So Mark.
Thank you, Francis, and thank you to the National Association of Corporate Directors for giving me the opportunity to have this dialogue with you. Let me start off by just explaining what happened with Silicon Valley Bank. The first thing to understand is that it is an extreme outlier in many, many ways. Take the level of uninsured deposits in a bank. For most banks, that's around 35 to 40% of their deposits are uninsured. If you look at the top 25 banks in the country, 60% might be a high number. Silicon Valley was 94%. That is what we call an extreme outlier. But that's not the only way they were an extreme outlier. Their average account size was $9 million. Put that in perspective, the average account size of Cadence Bank, the new name for Bancorp South, which I'm now a director of, is about, for a consumer account, around $15,000, for a commercial account, $150,000, compared to $9 million. The other way they're an outlier is their concentration of customers. A huge percentage of their bank customers were venture capital funds and the companies that those funds invested in, so that a relatively small number of people had an outside influence on what could happen to the bank. And finally, you could look at their being an outlier in terms of growth. One of the red flags in banking is extreme growth. And this is a company that doubled in size in 2021 and doubled again in 2022. So they were an unusual bank, and in many ways not to be compared to other banks in our country. But what happened to them is actually something that has a lot of concern for all banks in the country. And that is the combination of social media and electronic withdrawal led to an extreme reaction that we've never seen before. The last major bank in the country to fail back in the great financial crisis was Washington Mutual. In that situation, there was an outflow of deposits of about $7 or $8 billion over a period of a couple of weeks. In this case, there was a withdrawal request of $42 billion, about a quarter of the bank's deposits, in a morning, and additional requests for withdrawals that weren't honored because the bank was closed for $65 billion. Over half of the deposits in the bank were seeking to be withdrawn in one day. We have never seen anything like that, but I think we could see it again. And that's because now we have social media, which can overly influence people, and electronic withdrawal, which makes it possible on your telephone to withdraw vast sums of money. So I think those are events that are going to cause concern in the banking industry for many years to come, and in my opinion, are going to need to cause changes in regulation and deposit insurance rules. How that plays out, we'll have to see over the next year or so. But that's what happened here. And with that, I'll turn it over to Chris and look forward to answering Francis's and your questions.
Well, thanks, Mark. I would like to just echo my thanks on behalf of Lockton and myself, the NACD, to allow me to be a part of this panel and look forward to the discussion. I would echo what Mark said in terms of this being, potentially an isolated circumstance. I come, as Francis said, from a little bit different perspective. I've spent 30 years helping our clients buy D&O coverage and craft D&O coverage and sort through D&O claims. And I think the perspective I bring is, what are the D&O underwriters concerned with now? And I think that will give you a real view into, what they're concerned with from a risk culture standpoint. And I think it's also important to say, how is the impact, unfolding from a bank director's perspective? But I know we've got a lot of folks on the phone today that are not directors of banks. They're directors of other, types of companies. And I'll speak to that as well, because everybody has a banking relationship. So Francis, with that, appreciate the opportunity and look forward to the conversation.
Great, thank you both. So just to start our discussion, the risk profile of Silicon Valley Bank has been frequently described as hidden in plain sight. And the reason for that was that all of their financial risk exposures were clear in their 10K, their call reports, and other filings. And banks of SVB's size are required to have a risk committee. In your experience, Mark, how should the risk committee and the full board have handled this situation?
Well, there's another element that banks have that many other industries don't, which makes the situation perhaps even more egregious. And that is that banks have regulators. And the regulators repeatedly examine banks and make suggestions about how banks could be improved, how the operations of the bank could be improved. Some of those are called supervisory recommendations. But the more extreme ones are called matters requiring board attention. And those matters must come to the board, must be discussed by the board, and there must be a plan of action for how the bank management is going to deal with those questions. In this case, they had a number of matters requiring board attention that dealt with the issue of the mismatch between their deposits and the investment portfolio that they had. And yet they seem to take no action on it. Now you can fault the regulators for not enforcing those recommendations, and they had tools that they could have used to be more forceful. They didn't do that. But on the other hand, I don't know of a bank director that doesn't pay attention to those requirements, because they're at risk with regulators and with their own liability if they ignore them. In this case, clearly what happened, what should have happened, is that the risk committee should have looked at the situation of the large uninsured deposits and the possibility that large uninsured deposits could leave the bank. No one might have predicted that they would have left so quickly, but nonetheless, you have to look at the possibility that they are going to leave over time, and what are your alternatives if they do leave. Typically, a bank can go and borrow from the Federal Reserve to fill that hole if necessary. But in this case, the collateral that they had put up for the Federal Reserve wasn't sufficient for them to stem the tide. So should they have brought this matter to the attention of the board? Yes, they should have. Another point that happened was that the chief of risk, the chief risk officer position was left vacant for 8 months and not filled. How could that happen in a situation, and how could the regulators have not been more specific about the need to fill that position? I think if you look at it as a general point and trying to step back, number one, I would say in regulated industries, you should pay attention to what the regulators say. There's a tendency to dismiss what the regulators say. They're just bureaucrats after all. That's a tendency of often people think that. My own personal experience, maybe formed in the 1980s when we had our own crisis in Texas, is that the regulators were more right than we were in looking at the problems that we had. And the fact that they were looking at those problems and bringing them to our attention was one thing that enabled our bank to merge into a larger bank before the crisis became even more difficult to handle and banks failed, as other banks in Texas did. So I've always been a believer in paying attention to regulators. Now, what if you do if you're not in a regulated industry, then you've got a broader problem. And in that, I think it's just a question of asking questions, of always asking questions. And directors should never be afraid to ask questions about what are the risks, what are the things that could happen that would be problematic for our company.
Thank you, Mark. Chris, as someone that specializes in directors and officers insurance placement for your clients, what are the D&O insurers now asking about the role that directors are playing in risk management oversight as a result of these recent bank failures?
Yeah, Francis, and I saw there was a chat question that already came up about what is D&O, and maybe I can take a step back. Yeah, you're right, D&O insurance, and that's why I'm on the panel, and that's what we help our clients procure. And if you think about the major bank failures, and it's more than SVB, right? It's SVB, it's Signature Bank, it's First Republic. All of those banks are now facing class action securities litigation, so D&O litigation. SVB in particular is facing derivative litigation. It's facing investigations from the SEC, the Department of Justice, state attorneys generals. In fact, their auditor, KPMG, and some of their underwriters, Goldman and Bank of America, are now facing litigation. So, that's part of the reason I think my perspective may be valuable to some is how does that all work from a bank failure, and then how to underwrite, D&O underwriters view that risk, and what kind of questions are they now asking? If you are a director of a bank, your bank is going to get different questions now as a result of these bank failures. And Francis, the questions are numerous for bank. I really want to talk about two buckets here. It's really the banks and then the non-banks. But if you're a bank director, your organization is going to be asked a lot more about liquidity management and financial agility, having the assets available to act quickly. Questions around industry concentration risk. If you think about SVB, they were, to Mark's point, very heavily concentrated in the VC world, in the venture capital world, and with really smaller, many smaller, bank lines. On the other hand, Signature Bank was very much into the crypto market. So those concentrations of risk are an important thing to try to understand. The investment portfolio makeup, I think we're all pretty aware that, interest rate movement and those banks, reliance on some long-term bonds and a very high concentration of long-term bonds had an impact. So, underwriters are asking about that. Relationships with regulators. Mark touched on that. What is your interaction with regulators? Social media risk. I think we'll probably talk more about social media risk, and that the pace that the run on the bank occurred is something that underwriters want to understand. How are you going to respond if there is a bad day? Board assessment. Does the board have the requisite financial acumen in terms of risk management and trying to make sure that you understand what the risks are? Do you have a chief risk officer? Mark talked about the absence of a chief risk officer at SVB for a long period of time. And then I guess lastly, I would say is there a clear record of discussions about financial risk at the board level? And is there a record of that? That's for banks. Very quickly, for everybody on the phone that's not a director of a bank, there are questions coming there too from a D&O perspective. What are your banking relationships? What is your concentration of risk to any one particular bank? What is your diversification of funding sources? So those are the types of questions we're hearing in the D&O insurance marketplace today.
Thank you, Chris, and thanks for also helping everyone understand. We use these acronyms as if everyone knows what they are, and so we'll have to correct ourselves on that. So also thank you for asking what that is. I'm going to jump to just, thinking about risk and the different types of risk that we encounter. Certainly, we often think about how risk affects strategy, and that is one of the key aspects when we talk about risk. We have to look at, how we minimize the risk and optimize the opportunities and ensure that those things are aligned. And we just look for all of the upside that we can. But what about reputational risk? Are there unique lessons from the recent bank failures to be learned about reputational risk in a crisis such as these situations? This is for both you and Mark, Chris. So either one of you. Mark, you want to take the first shot at that?
Sure. We've got some great examples. I mean, if you look at the other two banks that failed, Silvergate was a bank that dealt almost exclusively in the crypto world. And when FTX failed and it became evident that it was a fraud, then the whole underpinnings and trust in that world evaporated overnight. And the bank had no choice but to liquidate itself. Fortunately, they had sufficient assets that they could liquidate themselves without loss to the FDIC fund. Signature was more complicated because it, to some extent, was a diversified bank, and they dealt with many customer types. But FTX was one of their customers, and they had a number of crypto customers. And the conjunction of the FTX failure and fraud with there being a bank that banked FTX and was proud of the association led to a significant loss of confidence in Signature and ultimately led to their failure. We're seeing a little bit of that with First Republic. It's not quite in the same as boat as the others. It's stronger than the others, but still it's the association that gets people. And so the reputation risk is important. Banks have been subject ever since the Dodd-Frank laws to this a law which is translated as know your customer. And most customers are unhappy that we have to investigate their background. Where did you get your money? How did you get your money? Who are your partners? People don't like that in general, although they've gotten used to it over the years because all banks are required to ask that. And the reason they're required to ask it is for a very good reason. We've just seen it. If you're not confident in the quality of the customer that you have, you're going to be tarred. And in some cases, tarred mortally. Now, what about non-banks and reputation risk? I think that it's just an element. As somebody says, you can take years to build a reputation and 1 minute to lose your reputation. And I think that that's true in personal life, and that's true in corporate life. And if it's magnified greatly by social media, and the fact that anything that you do can be filmed and circulated widely causes that reputation risk to go up enormously. So I think it's a new thing. I mean, a newer thing. It's an old thing, and yet the risk of it has magnified tremendously. And I think it's something that people have to be especially on guard for.
Yeah, Francis, the only thing I would add, totally agree with Mark. I mean, I think, reputational risk, we've seen many examples of companies that have faced reputational risks that have been damaging to the brand. But, you think about banks and the speed of which this occurred has a lot to do with it. And to Mark's point, we keep talking about social media. The ability to move funds quickly based upon knee-jerk reactions of social media is something new for all of us. And so the reputational harm that occurred with some of these banks was significant and has impacted them greatly.
Well, an adjunct to this would be, typically most companies, go through a crisis planning exercise. I would say many companies, have their crisis plans on a shelf. They often pull them out once a year. There's someone that's in charge of their, crisis tabletops and crisis planning. But in light of exactly what you've just articulated, the speed of what happened with these banks, particularly with SVB, the role of social media, how quickly that unfolded. Chris, in particular, what are the implications of, in your thoughts, of crisis planning, the role that that plays within a company, and how that really affects, or if it does affect, some of these questions you're asking the directors and the officers in terms of, you know, what you're insuring against and how they're planning for that in the future?
Yeah, I think it's about the speed, and you know, you think about how fast things moved, and the impact that it has had. Sorry, I just lost my train of thought. You know, the D&O underwriters want to understand how are you prepared for that type of thing? Because if you think about technology companies, or you think about, you know, public facing companies, they are used to something happening and responding very, very quickly. Maybe even having, you know, professional PR examples or firms, you know, at the ready to respond to a particular crisis. Banks not necessarily have had to do that in the kind of speed that would have been required to respond to these circumstances quickly. So I think it's somewhat of an industry function of, some industries have been through some of these events that you have to respond quickly to, and banks may not necessarily have.
So this question also is for both of you. You know, risk committees, banks of a certain size are required to have a risk committee. Other companies may have that dispersed amongst, you know, other various committees. It speaks somewhat to, you know, the governance and how all these various risks may be addressed. But I would say that the recent banking failures has brought up, there was a great article today in the Wall Street Journal about this, and it was really about the impact of social media, but I was particularly struck by a few comments in the article and about the risk of the unknown, and that the hardest risks to hedge are the ones that boards can't and management can't envision. And there's a difference between ignoring risks and getting blindsided, which we all know SVB did both. So if you have a risk committee, or you have the responsibilities for risk dispersed among various committees, what would you say are some of the best practices in terms of governance for boards in how to address these risks, and particularly now with speed becoming a new factor that no one anticipated, and there being so many other factors that we have to think about and try to envision in the future?
I think that if you look at what happened with Silicon Valley, there's always a tendency in all companies to sort of fight the last war. And in banking in particular, the last war is generally credit risk. If you look at the history of banking, the one thing that is above everything else in terms of problems is credit risk. So banks spend a lot of time focusing on credit risk. And this may be true of other industries where you focus on what has been the problem in the past. There hasn't really been a liquidity risk in banking in a long time. And what we found was, of course, an enormous liquidity risk at a speed that we'd never seen before. So yeah, it was to some extent was unimaginable that it could happen in that way. In hindsight, it's pretty easy to see that all the ingredients were there for it to happen. But it's always hard to imagine, you know, what hasn't happened in a long time. I think one thing that I've seen as a way of, in terms of corporate governance, is that annually management is asked to, you know, what are the top 10 risks that you face? Maybe it's competitors that are too large or too erratic. Maybe it's supply chain. maybe it's employee retention, maybe it's fraud. There could be a whole bunch of it. But the point is, put them down on a piece of paper. What are the 10 biggest risks? And then associate with that, what are the metrics that we should look at to judge the degree of risk in that situation? Some are hard to measure, but generally speaking, you can find some way to put down some kind of measurement. And then you can, between that annual period of listing the 10, you can look at a dashboard that says, where are we on all those risks right now? And I think that's a good practice that keeps people in tune with the fact that there are risks and that we should recognize them.
You know, Francis, you used the phrase fear of the unknown. And, you know, when you sit on a board, that's really it, isn't it? That's why you buy D&O insurance, is because of the fear of the unknown. And there are so many areas that can come from. Today, we're talking about financial risk management. The other things that come to mind for me are ESG things that are changing in our world. Cybersecurity is a big deal. So when you talk about best practices, I think what we're hearing more about is a lot more diligence around boards of having the right people making up any particular board, very tailored to that industry. What's good for a tech company may be very different from what's good for a bank, et cetera, et cetera. So I think that's a big evolution as well.
In both your experience, and Mark, this may be more specific to you, but do you think that most directors really understand how to, you talked about various categories of risk and actually cataloging those and developing a dashboard so that directors could understand what those risk profiles are and what the company's risk appetite is and what their risk tolerance levels are. But you can look at each of those verticals, if you will, and understand what that appetite is in each of those verticals, but taken as a whole and with all of the external factors, again, the risk of the unknown. Do you think that we're looking at all of those risks holistically and how they may come together and have an impact on a company in a way that individually and our individual appetites for that risk may not? I'm asked, that's not a rhetorical question, but
yeah.
You know, do you think that directors are really being able to look at that? Because management is in charge of risk. Directors are just in an oversight capacity. That's why I'm asking.
I think it's hard to do. I think it's hard to put everything together. I think you're right in separating the role of management versus the board. The board is there to ask questions and make sure that management is paying attention to risks and how those risks can come together. When you have the list of the top 10 risks, the number one question is, are they correlated? Are they going to happen at the same time? And is one likely to cause the other? So those are legitimate questions to ask. And I think but our role really is ask questions and make sure that people are thinking about various things. And that's the whole role. I don't think you can put yourself in management's position of having to enumerate all those risks and even to fully understand all those risks the way somebody that's been running a company for a long time can understand it. But the role of asking questions, I think, is the most important thing that board members can do.
Yeah, I think, Francis, you think about, you know, the fiduciary duty that directors have, you know, the duty of care and diligence, and it's important that, you know, as D&O underwriters look at this, they want to see boards that are involved. They want to see boards that ask questions, to Mark's point, that are on top of evolving issues, that have experience in those particular issues. And then they want to see companies that respond quickly to those questions.
And Chris, do you, when you're talking to boards, around the issue of D&O insurance. Do you have questions around risk culture and risk appetite? Are those things that, for D&O insurance purposes, are those important questions for you?
Yeah, absolutely. I mean, I think the whole goal is to put our clients in the best light possible from a risk culture standpoint. So asking really detailed questions around, financial risk management in some of the areas that I talked about earlier that D&O underwriters are asking about. I mentioned privacy and security. Lots of questions around where companies are taking their privacy and security evolution. ESG is particularly important for most companies, but some companies maybe like in the energy space, a lot of questions around that. So understanding that whole big risk culture is a big part of positioning our clients to get the best results in their D&O coverage.
One other question, we touched briefly on governance, but I'd like to dig into that a little more deeply. Just as I read more and more about these bank failures, it appears to me that there were a number of failures from a governance standpoint, and I could look at them really almost categorically across all bounds, where we look at, non-gov compensation, we look at audit, we look at all of the traditional governance aspects of a board. And I also break it down into the way I often look at things when I look at companies in my day-to-day life, which is typically, people, process, and priorities. Using those as some thoughts, I'd love to hear your perspective about the governance failures from your slice of the world that you see in these bank failures, and how those takeaways could be applicable to any company.
I think one thing you have in common, and I think this does relate to other industries as well, is a CEO who is highly regarded and has a reputation, strong reputation, and there may be a tendency in that case to say, well, if it's okay with him, it's okay with me. And I think that is something that can lead to laziness on the part of a board, and can lead to, especially if it's, I don't know how these boards were run. Some are run in sort of autocratic manners where questions aren't encouraged. And the general attitude is, you're here to rubber stamp what I tell you. That's a dangerous situation, no matter how revered the leader is. And I think I just get back to my mantra that you have to be on a board that is open to questions, that's willing to entertain questions, and you have to have directors who are willing to ask those questions. And if you don't have that, then you don't have good board supervision.
Yeah, I think about, from where I sit, material events that impacted the D&O world. If you think back to the .com bubble, or you think about Enron or WorldCom, or the mortgage crisis, or last year's crypto meltdown, or now, the bank failures, a couple of things. One, if it sounds too good to be true, it probably is. That sounds trite, but that had a lot to do with some of those failures. And then exactly what Mark's talking about. In all of those situations, you have boards that either didn't see or govern what was going on, or the management team didn't listen to them.
I might add just a couple of things, just from my perspective as both a director and someone that kind of looks at these types of things on a daily basis. I would say, to some extent, just based on what I've read, I certainly was not sitting on the inside of any of these banks, but from a non-gov perspective, did they have the right people and the right talent on the risk committee? From what I've read, probably the answer to that is no, because they had very few people on that committee that had any risk experience. From a compensation committee, who's to say? But you know, the ultimate question is, are the comp structures structured to provide the right incentives? And you know, only time will tell about that. But and then again, obviously, audit. You know, should audit have taken a look at this, and given the fact that some of the issues were hiding in plain sight. And again, you know, the risk committee, which we've already discussed extensively. But I do think that all of those things, particularly in companies where risk oversight tends to be distributed amongst a variety of committees, we do really need to think about that. And certainly with ESG, with some companies, they fall under audit. Some, such as the board that I sit on, we do have a risk committee because it is a bank, but we do have other parts of, you know, the E is now under the risk committee, but we, you know, have the S and the G under other committees. But we do have a report out, a comprehensive report out twice a year to the full board to ensure that we're looking at all of those factors and that the full board is engaged in those discussions. So it really is important. The governance piece of some of these things is a very important aspect of this. I'd like to give Mark and Chris a few minutes before we start taking questions to add any other commentary. I think it appears to me in the chat that we've got quite a few questions, and we may be able to take those a bit earlier, but and I want to leave plenty of time for those. So any other comments that you all would like to make?
So let's take the questions and then maybe we'll have some concluding comments at the end.
Okay, well, we'll kick off. Chris, this one I think is for you. In the late 1980s, D&O insurance for bank directors specifically excluded FDIC coverage, which made it almost worthless. Do you see that happening again? And if so, what industries might face exclusion from regulators?
Yeah, I'm old enough to remember that a little bit, particularly in Dallas with savings and loan world collapsing. Yeah, that regulatory coverage kind of disappeared around that time because of just the onslaught of claims. That has creeped back into the insurance coverage over time, into the D&O coverage, and many banks also buy what's referred to as bankers' professional liability, which is more of an E&O coverage for banks. So that's certainly something that we help our banking clients with. You're on mute, Francis.
Sorry, trying not to provide background noise. Beyond D&O, how should companies think of their banking relationship? When SVB failed, many companies were caught flat-footed, scrambling to make payroll. Mark, thoughts on that?
You know, I think that's a tough question. I think most companies of some size have multiple banking relationships. Smaller companies, less so. And yet you can have significant funds in your payroll accounts. That's one reason I think that we're going to have to change the deposit insurance rules. I think that I would favor, for example, raising the ceiling on payroll accounts, or raising the ceiling. One of the areas where it's particularly troublesome are nonprofits, who many boards, I think, feel even stronger than for-profit companies that they need to be careful about having uninsured deposits at all. I don't think we want to go to a system in the United States where it's concentrated in just a few banks. So if we're going to preserve a multi-layer banking system, I think we need to look at some changes in the insurance rules. Until that happens, all I can say is that it probably makes sense to diversify your banking options so that you're not faced with having to open accounts. It's just a question of transferring money from one institution to another.
What are some tools that can help boards look around corners to identify future high-risk areas? Other than a Ouija board.
Yeah, well, table game, it's kind of table war games, I guess is the answer. Asking the question of what are we not thinking about that we should be thinking about? It's a hard question to answer. And like I say, there's a tendency to fight the last war, and the next war is a little bit unclear. So I don't know how to get at that, or how you formulate the games that enable you to see what nobody else can see.
That goes back, Francis, to your fear of the unknown, right? I mean, we're talking about financial risk management today, but I keep, harping on cybersecurity. That is a world that changes every day. ESG, I'm not sure everybody really understands what ESG means yet and what the implications are of that. So it's, things like what we're doing today, I think are fantastic in terms of keeping your eyes open.
Well, I will add a little bit to this because I have experience in it in my day job, but I also have experience with it in my director role. And as a director, we kind of combined a strategy and a risk effort together. And we actually brought in a third party to help us do some imagining. And interestingly enough, I will refer you to this Ben Cook article in the Wall Street Journal today. It's a very quick read, but it's quite interesting. It is about a professor that analyzed the whole social media, but the nuggets for me were right in the middle, talking about that these bank failures were as much a failure of imagination as anything else, just really not being able to look into the future and realize what could be coming down the path. And that's the point. It's the risk of the unknown. Well, we're all facing that as directors. And there's no predictability to it. But if you get the right people in the room, and by the right people, it may be various people within your company, and the collective dynamic of that, and the collective dynamic of knowledge sources, subject matter experts, combined with directors, and everyone discussing the potential of risks, it is amazing the things that you can think about and the impact of one thing against another. It to some extent is a play on a SWOT analysis, but it's not a true SWOT analysis. It's really trying to imagine into the future. And then having a third party facilitator help you pare back on those. I'm not saying that's for everyone. And we didn't spend hours on this. We did it in several sessions of about an hour and a half each. And it was extremely productive, extremely insightful. And I think we all walked away feeling that we learned something and feeling better about having, it's what I refer to as generative thinking. And you need to do it on a fairly regular basis. For our board, we always have an annual retreat where we're not discussing typical board matters, but we have topics that really are generative thinking, where we have an opportunity to think into the future, think strategically, and think about these types of things that we should be thinking about. So that's my 2 cents worth for whatever that might be helpful to you. So this is a great question. Do you think the risk at SVB was a known unknown or an unknown unknown? I'm not touching that one.
I think it was known. I think that one other element of being an outlier that I didn't mention was the depreciation in value of their securities portfolio. For most banks who have securities portfolio, obviously with rates going up, those have depreciated in value. If you look at the impact on capital for most banks have about 10% capital in relation as a percentage of their assets, equity as a percentage of assets. For most banks, if you took into account the depreciation in the bond portfolio, that would go down to 8%, 7%, maybe some banks to 6%. Silicon Valley was zero, went down from 10% to zero. So it was an outlier on that. And I think if you look at all those things in combination, you would say that this was something that was just waiting for somebody to like the match. Now, somebody doesn't always like the match, and therefore maybe you can get by with it. But certainly the ingredients were there for everyone to see, and it just took the match.
Yeah, and the only thing I would add, Mark, is I mean, their client base was, very focused in the venture capital world with tech companies and fintech companies and biotech, and they grew very fast in the environment that we were in, and that was very much a known target of the bank.
The three greatest risks in banking are concentrations, fast growth, and credit as a broad matter, normally real estate. But concentration and growth are the biggest red flags you can have.
Well, to that point, as corporations move forward on establishing new credit facilities or renewing existing ones, what key factors should they be examining in choosing the lead bank and other banks taking positions in the credit facility?
I'm sorry, I didn't get that fully.
Sorry. As companies move forward, as they're establishing new credit facilities or they're renewing their existing facilities, what are the key factors that they should be considering and examining and choosing the lead bank and then other banks that will participate or take a position in the credit facility?
Well, there's a lot of issues in regard to that. I mean, surely you want your bank to be one that's financially stable. And there are ways you can judge that. You can't be a bank analyst, but most large banks have public ratings. And there's a variety of things you can go to judge that. I think, though, what you're looking at more importantly is how responsive is the bank? How have they dealt with problems when they come up? How have they successful are they in syndicating credits? So there's a whole variety of issues that go way beyond any thoughts about financial stability. I do believe that the need for participant banks tends to be left to the lead bank. Again, it depends on the size of the company. If you have deposit relationships with all those other banks, they may need to participate. So it really, I don't think there's any one size fits all. It really relates to your whole relationship and how responsive that bank has been and what its capabilities are with regard to what you need. If you're an international company, you need international capabilities. If you're very local, then you may not need that. And responsiveness and ability to deal with problems may be more important than anything else. So it really depends on the situation.
Chris, anything to add to that?
The only thing I would add is, I was listening to Mark talk, is some of the things that the DNO underwriters are asking. I mean, asking about concentrations of risk in any particular industry, or asking about, their agility to act quickly, what their investment portfolio management is, things that most boards and banks are already talking about, but it's ultra critical now.
We have somewhat addressed this question just in our earlier discussion, but I think it's one we could expand upon a bit. It was suggested that the skill sets of the directors on SVB's risk committee did not correspond to the role of the committee. Can you please elaborate on this? We had mentioned this in talking about governance, but it would be helpful for the audience to hear any specifics, Mark, from your standpoint of having been such a leader in the banking industry, and certainly Chris, with what you're looking at in terms of D&O insurance.
In terms of the abilities of the people that were on the risk committee?
The skill sets, in other words,
Yeah,
the
I think you need
credentials.
in today's world, I think you need a mix. You certainly need some people that have been in banking. And been in banking is a variety of things. If you're a relationship banker, you may not know all the details about the operations of a bank and the financial function of a bank. So I would say, if it's a bank, I would say you need people that have been in the operations or financial end of a bank. But you also need tech people for sure, with the risk of cybersecurity and all of that entails. You need people that have a general management background, because a lot of these are just a lot of times you get common sense questions that the technical specialists don't really think about. So I think it's really a broad range, but you certainly need, and I think this is true of almost any industry, you need people that have industry experience, you need people that have technical tech experience, and you need broad gauge management experience. And I think those are the three, generally speaking, types of people you need on a risk committee.
Yeah, I'd agree. I'm not familiar with SVB's, makeup of their risk committees, but it's like Mark said, I mean, it has to be a tailored approach to whatever industry you're in, but it has to have a financial risk management, discipline, and a privacy security discipline in all the areas that touch any particular company.
Okay, thank you. And I do think I'll just add again, the point of tailored to the industry is extremely important, so that the skill sets of those individuals, that they really understand the industry, but they really also understand how, what are the factors that impact strategy and how to manage risks, both financial and reputational, that they're thinking about risk, not just in the current state, not just in the day-to-day, but also the future risks. And that's what we were talking about earlier in anticipating risks. So there are such a variety of experiences that are needed now, because the breadth of risks are so great that what used to be considered risk is beyond just the usual kind of categories that we used to consider.
The other one I'd add for an international company is somebody with other directors with international experience, because
Right.
Again, it's a whole different ballgame, and you've got to have people that have been in that arena.
And the reality is, to that point, geopolitical risk, policy risks, for companies that have high exposure to certain regulatory regimes or policies, both in the US or internationally. So it's all of those things. It really is a bespoke approach, but you certainly need people that have got deep financial experience and understand how to deal with those things and translate those risks to the bottom line as well. Well, there's actually a question for me that deals with crisis tabletops and whether boards, should boards be involved in those, and if so, in what form? What I would say to you is obviously crisis management falls to the management team, but I would say that it is important for boards of directors to understand how that there is a crisis plan, and that there are scenarios associated with that crisis plan, that the company has really thought about this, that it's updated on a regular basis to reflect the current environment and current scenarios, that they are well prepared to address potential crises that are relevant to the company at that point in time, and that the board understands how they will be communicated with during a crisis, not that they will be asked to weigh in or participate in it, but how they will receive information, which usually should be through the CEO, obviously. And should there be a need for a board member to participate, usually the board chair or the lead director, how that would occur. Often a CEO may ask, depending on the type of a crisis, the CEO may ask for board input, but that is not the usual modus operandi. And boards should not think that they are actually going to play a role in the management of that crisis unless asked by the CEO. But what I always recommend conducting is what I call an executive and a board roundtable. So it's not what you think of as a typical tabletop, but it is about depending on the appetite of the group, a 30 to 45 minute roundtable just to walk them through an overview of the plan, how the communication chain will work, and how that will actually proceed, just so that they have a knowledge and an awareness. Sometimes this is done during a board meeting, just for a brief period of time. So, and I think that should be done on an annual basis. Happy to answer any follow-up questions to that, but that is how we typically handle it with our clients and what my experience. Now, I will also add on cybersecurity that I was asked as a director if we would like to participate in a cybersecurity tabletop for the bank whose board I sit on. And we were invited to actually participate. And we had about 8 or 9 directors participate in that. And they had a separate session for us because we really wanted to understand how that would unfold. And that was just an offer for us so that we could understand the intricacies of that. And it was a very nice offer, and we all enjoyed that. And so we could understand, obviously, for a bank, cybersecurity is a very deep concern. So, okay. Well, I understand we don't have any other questions. If you have one, either raise your hand or enter it in the chat quickly. But while we're waiting for any last minute questions, I think we'll let our distinguished panelists provide any key takeaways before we close out here. And Chris, would you like to kick us off, since Mark kicked us off with the introductory remarks?
You bet, Francis. I mean, I think what we're talking about today, very specifically about the bank failures and things to learn from that, is concentrations of risk can be very dangerous. If you think about the industry that I've been in for 30 years, the insurance industry is based upon diversification of risk and the law of large numbers and those types of things. And these examples that we've talked about today, there were not only concentrations of risk in the investment portfolio, but there were concentrations of risk in their client profile. And those proved to be, a very dangerous recipe for where these banks have landed. So I think diversification in any of our businesses that we talk about is really, really key to take away from this today.
And Mark?
Now, there was a book written by one of the founders of Intel, Andy Grove, called "Only the Paranoid Survive," and that was his motto. And I think that's really what we're talking about in terms of boards. It's easy for you to hear in a board meeting that things are going well, and to focus on the positives, especially when things are going well, and there are a lot of positives. But the thought about being paranoid about what can go wrong is really the key to, I think, being a good board member, and asking the questions that get in the way of this thought of how great we're doing as a company. And to me, that's the lesson here for all board members: is ask questions, don't drink the Kool-Aid, and think about what it is that can go wrong.
I could not echo that more strongly. It's really, as directors, we have to ask questions. It's our responsibility to ask questions. And, in terms of the risk profiles, if you don't understand it, if you're just being said, okay, this is what our profile is, and we're meeting our risk appetite, ask have we looked at this in light of the changing dynamics in the current environment? Are there other things we should be considering? How does this and this risk interplay with one another? Is the potential of a change in one of these verticals going to impact the other? There are questions that we need to ask, and not challenging management for the sake of challenging them, but for the sake of making sure that we're really fulfilling our duties as directors. So those are the things that I would add. I mentioned really the way I examine a lot of these situations, again, are people, process, and priorities. And I look at these bank failures, and it was a failure of the management, it was a failure of regulators, it was a failure of directors. They didn't follow the processes that they already had in place, and they didn't have their priorities in the right place. And so I don't mean to be trivial about it, but you usually can kind of look at things in those categories and put them there. I think the big takeaway on this one goes right back to this article that we were talking about. And I see in the chat that someone was asking, we'll send this to you, but it's the Wall Street Journal, "The Surprising Risk That Turbocharged a $142 billion Bank Run." It was by Ben Cohen, and it was in this morning's Wall Street Journal. And we'll send a link to it. And it really is about the risk of the unknown. And that's what we've got to try and stay 10 steps ahead of. And that, as this article says now, it's a risk of lack of imagination. It's a risk of lack of thinking ahead and trying to think about how all of these external factors can come together and have a real impact on your company and the business and its performance. So it's going to shake us out of our complacency in thinking that we have everything in hand. So those are kind of the key aspects of some of the implications of these bank failures. And at the speed at which all of our businesses are changing, about the dynamics, the external environment is changing, I think that risk of lack of imagination is probably greater than we think it is. I just want to again thank Mark and Chris for joining us today. This has been amazing. Your insights are so valuable to all of us.